Gold just fell more than 25% in 5 months. Every chart on your screen says sell. And I'm about to show you why that's the exact opposite of what the smartest money on the planet is doing right now. In the next 20 minutes, you'll get 3 things. First, the real reason gold and silver are correcting hard right now and why it has almost nothing to do with the reason the media is giving you. Second, the debt math behind this, the numbers that explain why this pullback is temporary. And third, a step-by-step accumulation plan you can actually use, whether you're starting with $500 or $50,000. Stick around, because point 4 is the one nobody else is talking about. Let's get into it. Here's the number that's scaring everyone out of the metals market right now. And here's why it's the wrong number to be scared of. Let's start with what actually happened. On January 29th, 2026, gold hit an all-time high of $5,897 an ounce. That was a huge moment. It meant gold had officially broken away from every previous ceiling anyone thought existed. Fast forward to today, July 2026, and the story looks completely different. On July 1st, gold's 50-day moving average dropped below its 200-day moving average. That's what traders call a death cross. It's a classic technical warning sign. The 50-day sits around 4,402, the 200-day around 4,486. Spot prices have pulled back over 25% from the highs and are now testing support somewhere between $4,100 and $4,200. Silver's in a similar spot, holding just above $60 an ounce after a rough stretch. Here's the thing about a death cross. It's a lagging indicator. It tells you what already happened, not what's about to happen. It's based on trailing price averages, which means by the time it shows up on your chart, the move that triggered it is already old news. Traders who exit purely because of a death cross are often selling into weakness that's mostly played out. That doesn't mean the correction isn't real. It is. Prices dropped, and that's a fact. But a technical signal on a paper chart doesn't tell you anything about what's happening underneath the surface, in the actual physical market and the macro system that drives it. That's what we need to look at next. Think about it like this. Imagine a car's speedometer that only shows you the average speed over the last hour, not right now. If the driver slammed the brakes 10 minutes ago, the needle is still catching up to that old data. By the time it fully reflects the slowdown, the car might already be speeding back up. That's basically what a 50-day and 200-day moving average crossover is doing with price data. It's useful for spotting a trend after it's already developed, but it's a poor tool for predicting what happens next. Anyone telling you a death cross is a guaranteed sell signal is skipping that detail. And it's worth remembering that gold has printed death crosses before during multi-year bull runs, only to grind higher months later, once the technical dust settled. So the headline, "Gold is crashing," is true on the surface, but a death cross measures trailing price action, not the underlying forces still pushing on the metal. Which brings us to the real story, the one written in trillions, not moving averages. While everyone's staring at candlestick charts, almost nobody's looking at the one number that actually explains all of this. The US national debt just crossed $39.2 trillion. It's growing by more than $94,000 every single second. At the current pace, it crosses $40 trillion by September. Here's what makes this different from just the government spends a lot of money. Earlier this year, the Bureau of Economic Analysis and the Treasury confirmed that debt held by the public passed 100% of GDP for the first time since right after World War II. That means the total debt is now bigger than everything the entire US economy produces in a year. The Congressional Budget Office is projecting a $1.9 trillion deficit for this fiscal year. Put another way, the government is spending about 1.33 for every $1 it brings in through taxes. That's not sustainable math over a long horizon. It's compounding. And here's the part that really matters for you as an investor. About 33% of all publicly held US debt has to be refinanced within the next 12 months. That debt was mostly issued when interest rates were near zero. Now it's getting rolled over at an average rate around 3.386%, more than double what it used to be. That refinancing gap alone is why net interest payments are on pace to eat up close to 14% of total government spending this year. When a government has to keep issuing new debt just to pay the interest on old debt, it creates pressure on the currency itself. That pressure doesn't show up instantly in a stock chart. It shows up slowly in the price of groceries, in the cost of rent, in the fact that your paycheck buys less than it used to. Picture a household that's refinancing a mortgage every year, and each time the new rate is higher than the last. For a while, they cover the gap by putting more on a credit card. That works for a year, maybe two. But eventually, the minimum payments alone start crowding out everything else in the budget. Groceries, savings, everything. That's roughly the position the federal government is in right now, just at a scale of trillions instead of thousands. The difference is, a government has one extra option, a household doesn't. It can lean on the central bank to help absorb the debt, which is exactly the kind of pressure that tends to weaken a currency's purchasing power over time. It also helps to understand why that 33% refinancing figure matters so much more than people realize. Government debt isn't one giant loan. It's made up of millions of individual bonds and bills with different maturity dates, some issued for 30 days, some for 30 years. When a big chunk of that debt was issued years ago at rock-bottom rates, and it all comes due around the same window, the Treasury doesn't get to renegotiate. It has to sell new debt at whatever rate the market demands that day. If rates are higher than when the original debt was issued, the government's interest bill jumps automatically, with no vote, no debate, and no way to opt out. That's the mechanical trap sitting underneath this whole story. And it's completely separate from anything happening on a gold trading chart. This is the mechanism most gold sell-offs eventually run into. A debt load that keeps growing, an interest bill that keeps compounding, and a currency that has to absorb the difference. Short-term technical charts don't capture any of that. But it's exactly why long-term holders of hard assets don't panic during pullbacks like this one. If gold is really in trouble, somebody forgot to tell the world's central banks, because they just had one of their biggest buying quarters on record. Here's the disconnect that most retail investors never see. When you check the gold price on your phone, you're looking at a paper market, futures contracts, ETFs, derivatives traded on exchanges like the COMEX. For every ounce of physical gold that actually exists in a vault, there are far more paper claims on that gold trading around the world. Retail traders and short-term funds move in and out of that paper market constantly, and that's a lot of what drives the day-to-day price swings you see on a chart. Now look at what the biggest, most conservative buyers on the planet are doing. According to the World Gold Council, central banks bought 244 net tons of physical gold in the first quarter of 2026 alone, well above their 5-year average pace. These aren't hedge funds trying to catch a quick trade. These are national governments, and they're not buying gold because they think it's going to double next quarter. They're buying it because gold carries zero counterparty risk. Nobody can default on it. Nobody can print more of it into existence. It sits on a balance sheet completely independent of any other country's promises. That's the split you need to understand. Paper price and physical accumulation are telling two different stories right now. The paper price is reacting to short-term rate expectations and dollar strength. The physical buyers are reacting to something much bigger and much slower, the long-term erosion of trust in fiat currency systems generally. This isn't a one-quarter blip either. Central banks have been net buyers of gold for years running, a shift that accelerated noticeably after sanctions in the last decade showed several governments that foreign currency reserves can be frozen or restricted overnight, while physical gold sitting in your own vault cannot. Once that lesson landed, diversifying reserves away from any single currency became a standard part of central bank policy, not just a defensive one-off move. A death cross on a paper chart and a record-buying quarter from central banks can both be true at the same time. One tells you what traders did last week. The other tells you what sophisticated, long-horizon capital is doing right now, and they're not selling. Here's the part almost no one covers when they talk about this correction. Silver isn't just a smaller, cheaper version of gold. It's playing an entirely different game. Gold is primarily a monetary asset, something people and institutions hold to preserve value. Silver does that too, but it's also a heavily used industrial metal. It goes into solar panels, electrical grids, and a growing list of high-tech and military applications. That dual role is exactly why silver tends to be more volatile than gold. It gets pulled by two different forces at once. Right now, silver is holding just above $60 an ounce, and it's dealing with a structural supply problem. Ore grades at existing mines are declining, energy costs for extraction keep rising, and demand from the solar and electronics industries keeps climbing. That combination, falling supply growth and rising industrial demand, is a very different setup than a simple risk-off sell-off. So when silver drops alongside gold during a broad market pullback, it's easy to assume the same story applies to both. It doesn't, fully. Gold's pullback is mostly a paper and rate expectation story. Silver's pullback is layered on top of a real industrial supply and demand dynamic that doesn't reverse in a few weeks. It plays out over years as mines take a long time to bring new supply online. Think about a single solar panel manufacturer that needs a steady, reliable supply of silver to keep production lines running. They don't care what a chart looks like on a Tuesday afternoon. They need the physical metal delivered on schedule. When mine supply growth stalls, while that kind of industrial demand keeps climbing year over year, the physical market tightens, even if the paper price is falling. That tension between paper price and physical tightness is a big part of why silver is historically more volatile than gold in both directions. It can fall harder on panic days and rip higher, faster, once industrial buyers start competing with investors for the same limited supply. If you only watch the gold chart, you'll miss why silver often moves faster and further in both directions. Understanding that dual identity is the difference between panicking on a red day and recognizing a structural setup that most headlines never mention. So, if you've made it this far, you're probably asking the obvious question. Okay, so what do I actually do with this information? Here's a simple framework. This is not personalized financial advice, and precious metals can still go lower from here. Nobody, including me, can guarantee a floor. But here's how disciplined, long-term holders typically approach a pullback like this one. First, they identify a support zone instead of trying to time the exact bottom. Right now, that's roughly the $4,100 to $4,200 range for gold, based on where the current pullback has found buyers. Second, many long-term holders prioritize physical bullion over paper products like ETFs, specifically because it removes counterparty risk. You're not relying on a fund or an exchange to make good on a claim. Third, dollar cost averaging is the tool most commonly used to deal with a volatile setup like this one. Putting a fixed amount in on a regular schedule, so you're not trying to guess the exact low, and you end up buying more ounces when prices are down. Fourth, most people who hold a metals allocation weight it mostly toward gold for stability, with a smaller allocation towards silver to capture the industrial upside we just talked about. None of this is a guarantee. Debt spirals, central bank buying, and industrial demand are all real, documented trends. But markets can stay irrational, and corrections can run deeper and longer than anyone expects. Precious metals also don't pay you interest or dividends while you hold them, so they need to fit into a broader plan, rather than be the entire plan. If you're considering any of this, talk to a licensed financial advisor who knows your actual situation, and never put in more than you can afford to have tied up for years, not weeks. The goal isn't to catch a perfect bottom, it's to have a repeatable process, so a 25% pullback doesn't turn into a panic decision you regret in 2 years. So here's the real takeaway. The death cross is real. The 25% pullback is real. But underneath that, the debt math is still compounding, central banks are still buying at a record pace, and the physical supply and demand story in silver hasn't gone away just because the paper chart turned red for a few weeks. Whether that adds up to a buying opportunity for you depends on your own timeline, your own risk tolerance, and your own financial situation. So do your own research and talk to a professional before you act on any of it. If this breakdown helped you make sense of what's actually happening in the metals market, hit like and subscribe so you don't miss the next one. And if you want to understand exactly how the Federal Reserve's interest rate decisions are connected to everything we just talked about, check out the video linked right here. It walks through the other half of this puzzle. Thanks for watching, and I'll see you in the next one.